Do you want to understand the difference between CAC versus CPA, or just figure out what the heck these acronyms stand for? By the end of this episode, you'll understand what the heck CAC, aka customer acquisition cost, and CPA, cost per acquisition, is, when to use it, and which metric is important for your business. I'm William Glass, CEO and co-founder of Ostrich, and your host of Silicon Alley. If you want to learn more tech and business terms, tactics and strategies, as well as hear advice from top entrepreneurs, VCs, and top performers, then pound that subscribe button and be sure to turn on notifications.
You got no time to waste, but still you hesitate.
So let's talk about CAC versus CPA. You may have seen or heard the acronyms CAC and CPA before. Often they're used in marketing, finance, and the business context. CAC, or CAC, stands for customer acquisition cost. This is how much it costs you, the business, to get a new paying customer. Paying being the key word. CPA, or cost per acquisition, is how much it costs you, the business, to get a new non-paying customer. For example, Facebook would measure its regular free users based on cost per acquisition, since it doesn't cost the consumer to use the application, whereas it would measure the business customers who buy ads based on CAC, or customer acquisition cost, as the businesses pay to use those advertising services. The general rule is that CAC measures the company's revenue source, and CPA measures the users who aren't paying but who support the revenue source. Facebook's ability to charge advertisers depends on how many free users it has and how much time they spend on the platform. So if you have examples other than companies like Facebook that use CAC and CPA metrics, drop them in the comments below. Would love to see what other companies you guys come up with. So before we dive into when to use CAC and CPA and who should be using them, let's talk about why they're important. For a business to be profitable and sustain itself, it must make more money than it spends, right? This is just basic economics. Where the long-term viability of any company is dependent on its cash flow, right? Having positive cash flow means the business, after all expenses, has more money than it spent. So as an example, let's say I have a software company that sells product management software. If we earn $1 million in revenue and our total cost to run the business is $500,000, we're cash flow positive and profitable as we make $500,000 after all expenses. If, on the other hand, it costs us $2 million and our revenue is only $1 million, now we're in trouble and we either need outside financing to keep the doors open or we will go out of business quickly as our cash flow is negative $1 million. So CAC and CPA are early indicators that tell us if we're on track to be profitable or not. If we see it's costing us more money to acquire a customer than we earn from them, it's not a good sign for the health of the business. So in the comments below, based on what we just heard, do you think it's better to have a high CAC and CPA or a low CAC and CPA, right? High or low? So I'll tell you a bit about how we are using CAC in my business. So I co-founded a fintech company called Ostrich, and now that our application is live on both iOS and Android, go ahead and download it. It's crucial for us to measure CAC. We need to understand how much it costs us to acquire a customer, as this is one of the key questions we get when speaking with investors. The proof is in the pudding, so to speak, and having a low customer acquisition cost is a really great sign that our application has the ability to scale, that we've hit product market fit, which we'll talk about in another episode. So our goal is to get a baseline for that CAC right now in the early days, and then figure out how we can reduce that number. So let's dig into acquiring or getting more customers. So a key component to having a successful business is acquiring more customers, right? If you don't have any customers, then how are you going to make money and you're not going to have a business, right? So how do you acquire those customers? Well, there's a number of ways to do it, and it could be through paid advertising, word of mouth, hiring, direct sales force, affiliate networks, referral programs, or some combination of the above. There's a cost in both time and dollars for getting a new user, whichever method you use. And so that's where customer acquisition cost and cost per acquisition come into play, right? So we want to measure them across all channels. We want to have one for our total business as well as each channel. So if you want to have a positive cash flowing and sustainable business, you have to spend less to get customers than what you earn in sales from those customers, right? If it costs you $400 to go get a customer, but you only make $5 per customer, you're not going to be in business for long. And so this is crucial to building a profitable business. We want to be making money, right, at the end of it, not owing money at the end of each month, quarter, and year. So it is important to note that even if you are a venture-backed company or you're planning on raising capital, maybe you have a bunch of money in the bank and you're just not worried about being profitable right away, the CAC and CPA metrics are still going to be crucial to know. They ultimately help an investor, as well as you, the business owner, understand if and when the business will be profitable. And it'll help you determine the economics of any current future investment and how you should be allocating your marketing dollars, right? So as I mentioned earlier, this is one of the first questions investors have asked us when it comes to these metrics. Low acquisition costs, both CAC and CPA, shows that people find value in your product, and that if you dump investor capital, right, if you're getting an outside investment into the marketing of the product, you can efficiently scale the user base and grow your market share. So, which metric should you use in your business, CAC, CPA, or both? So let's talk about which metrics are most important to your business. For technology companies who have a mix of users that are paying and non-paying, both metrics are likely important. Many SaaS or software as a service businesses will use either an ad-based model like Facebook or a freemium model where you can get access to basic services and features for free, but if you want premium features, you pay to upgrade. So again, think Facebook, LinkedIn, Slack. If you have if you do use a freemium business model, it's important to track both cost per acquisition, that cost to actually get a free user, and then CAC, customer acquisition cost, or the cost to get a paying customer, right? The reason is that on the freemium business model, oftentimes a user will start off as a free user and then upgrade at a later date to a paid version. Sometimes you'll have users go straight to the paid, but more often than not, you'll end up having people go from free, testing it out, and then moving forward. So either way, it's important to calculate both. But if on the other hand, you're an e-commerce business or you don't offer a free product or service, then you can pretty much just stick to customer acquisition costs, right? If you sell custom t-shirts online, someone either purchased a shirt or they didn't. Just calculate the CAC, meaning how much you spend to get a sale from a new customer, right? Just track that metric. So for us at Ostrich, we're actually using CAC over CPA at the moment, despite having a free application for users to use. And the reason is that our initial revenue stream depends on users signing up for financial services and products within our application, right? We don't offer them, but if people need them, we'll make recommendations. And so at this point, we don't have another revenue stream. We've got it on the roadmap, but we don't offer a subscription to either consumers or businesses. So right now, the way we're doing our CAC is by factoring in that kind of conversion rate into our numbers from the number of people that will actually click and sign up for other services through our application. So as we roll out additional revenue streams, we will revisit both CAC and CPA. So how do we actually use CAC and CPA? As we covered, there are a number of ways to acquire a customer, which I won't get in detail today, but one of the easiest ones is to tap into, especially for technology companies, is advertising, right? Digital advertising. Think banner ads, YouTube ads, search ads, social media ads. These ads, they cost money, so it's important to know which ones are effective and what your CAC and CPA are. There's this cliche in advertising that goes, half the money I spend on advertising is wasted. The trouble is I don't know which half. And so specifically with digital advertising, we're able to better measure the effectiveness of our ads and determine which half of our advertising dollars are being used appropriately and the others that's being wasted. So these two metrics, CAC and CPA, can help us determine those two things. And the first piece of that puzzle is the overall advertising efforts. Are they effective, right? What's the overall CAC and CPA across all channels? On the whole, are we spending less to acquire free and paid customers than we earn in sales? The second is to drill down into which advertising channels give us a better return on our investment, right? So, for example, if we're using both Facebook ads and Google search ads, you'll want to calculate the overall CPA and CAC for both channels combined, but as well as individually, right? Because you might find that it's cheaper to acquire a customer on Facebook than it is on Google, and that's really important to understand, right? And then from there, you'll be able to actually drill down even deeper, and that's what we're doing at Ostrich, right? We're calculating CAC on an overall basis as well as channel specific, but then within that, we're also testing other variables like demographics, age, income, things like that. And so by being able to measure each piece individually, we can have a control group and figure out what's working better channel-wise, demographic-wise, as well as content-wise, right? Is it our 15-second video ads or our 30-second video ads? Which ones perform better and convert at a higher rate, thus giving us a lower customer acquisition cost and CPA cost, right? It just allows you to make smarter decisions. So to recap, CAC is the cost to acquire a paying customer, and CPA is the cost per acquisition of a free non-paying user that supports that money source. So every business should calculate CAC, and some businesses will want to calculate CPA as well. So there are plenty of other metrics that are important to understand, such as conversion rate, LTV, which stands for lifetime value of a customer, churn rate, many more, but for now you've got the basics of customer acquisition cost and cost per acquisition. So now you need to go calculate how much you spend to get a free user and then how much to get a paying user. Keep track of those metrics over time and you'll start to spot trends in your businesses. So if you enjoyed today's episode and got value, please be sure to pound that subscribe button, subscribe to the podcast, share the episode with others. That's it for the Silicon Alley Podcast. I'm William Glass, CEO and co-founder of Ostrich, and of course, host of Silicon Alley. See you next time.
You got no time to waste, but still you hesitate. Caught in a circle saying I'll never